We are concerned particularly about those who have low income and who are more vulnerable to not only the risk of recession, but to the reality of inflation.
The recent implementation of tariffs by the United States, spearheaded by President Donald Trump, has sent shockwaves through Europe. This sparking widespread concern has prompted a question: are we on the brink of a global recession? So let's find out. While the correlation between stock market fluctuations and overall economic health is complex, the current market volatility warrants a thorough examination. It's crucial to understand that a decline in share prices doesn't automatically translate to economic collapse. However, the magnitude of the recent market downturn suggests a significant reassessment of future corporate profitability. Specifically, market analysts are anticipating that the imposed tariffs will lead to increased operational costs and decreased profits for numerous companies. This, in turn, elevates the risk of a recession, a scenario defined by 2 consecutive quarters of economic contraction where total spending and exports decline. While it's premature to definitively declare a recession, recent economic data provides cause for concern. For instance, the UK economy experienced minimal growth between October and December of the previous year, followed by a contraction in January. The upcoming release of February's economic figures will be closely scrutinized for further indications of a downturn. The market's reaction has revealed some particularly alarming trends. The performance of banking institutions, often seen as a reliable indicator of economic stability, has been notably weak. Major international banks such as HSBC and Standard Chartered, which facilitate trade between Eastern and Western markets, witnessed significant drops in their stock values. Additionally, commodity markets, specifically copper and oil, have experienced substantial price declines, signaling a potential slowdown in global economic activity.
Welcome back. We've been talking about those tariffs from Donald Trump all morning. China's already hit back with reciprocal tariffs, but we're still waiting to see how Europe will respond. Germany is the EU's biggest economy, and Berlin's man in London joins me now, Ambassador Miguel Berger. Morning, Miguel.
Morning.
Should the EU regard it as a compliment that the President of America can't seem to stop talking about how unfair the bloc is and, by implication, how much impact it has on America?
Yeah, it's we could laugh about that, but it's really devastating. I think it's the biggest assault we have seen since the end of the Second World War on global trade, and we all will have to find a way to deal with it.
Historically, synchronized global recessions are rare occurrences, with the 1930s, the Great Financial Crisis, and the pandemic being notable exceptions. While a recession of similar magnitude is not currently projected, economic analysts have revised their forecasts, indicating a heightened probability of recessions in the United States, the United Kingdom, and the European Union. On a potentially positive note for the UK government, the increased demand for government bonds, considered a safe investment, could lead to a reduction in borrowing costs. However, this potential benefit may be offset by decreased tax revenue if the economy enters a recessionary phase. In this climate of economic uncertainty, it is imperative that all information disseminated is accurate and factual. Misinformation can exacerbate market volatility and public anxiety. Therefore, all analysis and reporting must be grounded in verified data and expert consensus. Furthermore, any information provided should be presented in a clear, accessible manner, avoiding overly technical jargon. It is essential to maintain the highest standards of journalistic integrity, particularly when reporting on complex economic issues that have the potential to significantly impact global stability.
The tariffs will also hurt consumers around the world. It will be felt immediately. Millions of citizens will face higher grocery bills. Medication will cost more, as well as transportation. Inflation will go up. And this is hurting in particular the most vulnerable citizens. All businesses, big and small, will suffer from day one. From greater uncertainty to the disruption of supply chains, to burdensome bureaucracy, the costs of doing business with the United States will drastically increase. And what is more, there seems to be no order in the disorder. no clear path through the complexity and chaos that is being created as all US trading partners are hit.
As you might have already known by now, global stock markets are experiencing a significant downturn following the United States' implementation of extensive tariffs, raising concerns about a potential stock market crash and its broader implications. While the term crash carries significant weight, it's essential to analyze the current situation with accuracy and avoid any misrepresentation of the facts. Historically, a stock market crash is typically defined as a sudden and substantial drop in stock values, often exceeding 20% within a single day or over a very short period. Notable examples of stock market crashes include Black Monday on October 19, 1987, when the US stock market plummeted by 23% in a single day, with similar declines observed in other global markets. The Wall Street crash of 1929 witnessed a loss of over 20% in 2 days and a staggering 50% within 3 weeks, an event that triggered the Great Depression of the 1930s.
By the announcement from the United States. Let me be clear, Europe did not start this confrontation. We think it is wrong. But my message to you today is that we have everything we need to protect our people and our prosperity. We have the largest single market in the world. We have the strength to negotiate. We have the power to push back. And the people of Europe should know that together we will always promote and defend our interests and our values, and together we will always stand up for our Europe.
In the current scenario, the US stock market has experienced a decline of approximately 17% from its peak in February and is currently down by 2% compared to the same period last year. While this represents a significant correction, it does not yet meet the historical definition of a crash. The UK's FTSE index has also experienced a sharp decline, although not as severe as the US market. The imposition of these tariffs by the US administration under its previous leadership has introduced considerable uncertainty into the global economic landscape. The expectation is that increased tariffs will lead to higher costs for businesses and consequently reduced profits. This apprehension about future profitability is a key driver behind the current market volatility. The tariffs have disrupted established trade relationships and supply chains, creating an environment of economic instability. What unforeseen ripple effects might we be bracing for in the months ahead? And how will everyday individuals navigate this evolving financial landscape? Let us know in the comments, and if you want to stay on top of this, smash that like and subscribe button.